Hi everyone, I am Afshin Moshrafi, creator of TradeWave, and we are in a week-long webinars of going over Santa Claus rally and basically TradeWave in the context of Santa Claus rally. So today's Thursday, December 19th. Happy holidays. 6 more days before Christmas. Let's go to the presentation. So, what is Santa Claus Rally? Santa Claus Rally was first found by Yale Hirsch. Hirsch found that a consistent pattern of higher stocks prices during the specific periods of December 26th to January 3rd was prominent. He actually found this in 1972, and he's the one that coined the name Santa Claus Rally. He said why it gained attention. Hirsch's observation resonated with traders and investors who saw opportunities to capitalize on this pattern. His documentation turned a casual market observer into somebody who can actually run a strategy and use it. So his view is what we're going to call the traditional view. His view was that the rally occurs during the last 5 trading days of December and the first 2 trading days of January. In the context of this year, that will be December 26th to January 3rd. Now, TradeWave allows you to take a look at these dates and see exactly how S&P 500 performed, which is the broader markets we're going to look at. Let's look at TradeWave. We're going to click on Wave Viewer. We're going to select Indices Common, SPX, and we're basically going to put down the dates that he mentioned, which is 26th, day after Christmas, and it will be 9 days long. And here it is, 12/26 to January 3rd for this year, which is the second trading day of the year. Take a look at this. This is showing the gain and loss of S&P 500 for the last 10 years between these 2 date ranges. If you have gone into S&P 500 basically like by SPY and waited until January 3rd, you would have actually lost 8 of the 10 years. Even in 2021, that was a winner. It basically was flat up. 2022 was a flat down. 2019 was flat down also. 2023 it lost almost 1.5%, and 2014 it lost 3.26%. This is not as good Santa Claus rally traditional view for the last 10 years. Let's take a look at all the data we have, which is 96 years. We can also go to our stats table. Our stats table actually showed this is not bad. 64 of 96 years was a winner, 67% of the years, and 32 of those years were losers. The average gain was 2.22%, and the average loss was 1.15%. This is actually not bad, especially because average gain is higher than average loss, and you had a 2 to 3 chance of winning over the last 96 years. Not too bad. However, this was coined in 1972, and other views came into play. And the second one is an expanded view that people believe that it actually is the entire month of December is the Santa Claus rally, driven by holiday spending and general optimism. Let's take a look again at TradeWave. Right now we have 96 years selected. All we have to do is take the shortcut, date range shortcut, and just say December. Basically this shortcut, all it does, it sets up the date ranges to what we are looking at, which is the beginning to the end of December. If you would have gone in at the first day of December and got out on the last day of December, you would have been a winner. 75%, 3 out of 4 years in the last 96 years. 72 of last 96 years would have been a winner. It's much better. In 2023, it did lose 2.89%. How about last 10 years? Last 10 years, it was up 70% of the years. However, in 2024, so far, it's down 2.89%. So S&P has been dropping last few days. Let's go back to our presentation. Some other people argue that it begins in middle of December leading up to Christmas Eve, basically December 15th to December 24th. Let's also take a look at that. In our case, we say December 16th because December 15th was a Sunday, and we select 9 trading days, which would gives us exactly this date range of middle of December until Christmas Eve. When we take a look at this, it was 60% of last 10 years was a winner. This year is so far a loser, down 3.32%. Let's also look at all of our data. In the last 96 years, it was a winner 61 of the last 96 years. So profitable 64% of the years. It's not really great. But now let's take a look at what is the most optimum date range in this vicinity using TradeWave. I've already done that. I'm just going to show it to you. You can always go back and take a look yourself. And the date range that I found was December 16th until January 6th. So I am going to go to TradeWave and basically put that in December 16th until January 6th, which is 22 calendar days. All right, look at that. When you look at it in this date range, which is December 16th until January 6th, we do much better than all the other date ranges people have been looking at in the last 60 plus years, about 60 years. 82% of the years was a winner, straight with this date range. You get in on the 16th, you get out on January 6th. 82%, which is 79 of the last 96 years, was a winner. The average gain was 2.8%, and the average loss, minus 1.86%, substantially lower than the average gain. This looks pretty promising and pretty good. However, this year so far, it's down 3.32%. So, what did we learn so far? This is the date range we should basically look at for Santa Claus rally. How did it do last 10 years? Well, forget about this year so far. Last 10 years, it was a winner 9 out of 10 of the years. The year that you would have lost 4% was 2015. The markets were pretty not Santa Clausy. Now let me show you something else. I said on the video that Santa Claus rally that we found is 90% accurate. However, we just took a look at this, which is 82% accurate. We're going to go and click on MFE. That's maximum favorable excursion. That means what is the maximum price reach during this date range? How high did it go before it came and closed at whether a smaller gain or a loss? This is shown by a light green. So what does this really mean? Let me click on one of these and show you, like this one. In 2014, we are showing that there was an overall gain of 1.51% during this date range. However, the light green part shows an additional 4.61%. When I click it, I can actually see this. Do you see where we started on the 16th and when we closed on January 6th? It is a clear winning trade. But the S&P 500 price just shot up here from 1972 to 2090 before dropping and making a close for the date range here on January 6th, which is 2002. It's a winner, but if you would have known to get out here, it would have been a lot more profitable. This was this year of 2015. Yeah, starting with 2014 and January 6th in 2015. So this is how it's showing it with a light green part. So why do I say this is 90% accurate? Let's decide to go with a target of 2% gain on the broader markets after January 6th. If you were going for a 2% gain, look at it here. In year 2007, although you would have lost 2.06%, S&P 500 first went up 3.66%. If you're targeting 2%, you would have been out with a profit. This would be a profitable year. In 2004, it went up 1.21% before closing and losing 1.27%. So this would have been a losing year. 2000 would have been a winner because it went 2.08%. By the way, over here, depending on your strategy, I would have been very close to going on break even. So in some of those years, I would have actually been break even. 97, it went up 1.5%. I would have been break even here. But then it closed at flat down, minus 0.15%. Again, 1.98%. Either I would have been out in 1990 or I would have broken even here. Definitely a loser in 1985. 1981 would be, I would be out or break even. Definitely a loser in 79. Definitely a winner in 1977 when you target 2%. And here it goes. 1968 would have been a loser. 61 a loser. 56 would have been a loser. So it would be 1936. So if you count the light green parts that are at or near 2% and add it to the winning years, you would be very close to 90%. So this is how I target 90% with this Santa Claus rally date range that we found with TradeWave. So I officially call this the TradeWave Santa Claus rally date range. December 16th to January 6th. Let's go to 10 years and then take a look at this year again. This year so far, we're down minus 3.32%. Let's click on MAE, which stands for Maximum Adverse Excursion. That is showing us the extent that the prices went against us before it came back at either closed slightly higher or became a winner. So we can take a look at to see how close to normal is this. See, it went down minus 2.95% in 2021 before closing up 0.59%. 2018, it dropped minus 7.83% before closing up 0.15%. And in 2015, it went down actually about 4.5% before closing at minus 3.99. So this is how I take a look to see if the drops are normal. So far, I would say this year has a chance of going back up. Is it guaranteed? Absolutely not. These are probabilities, and we are taking a look. There are years that this is not going to work, but the probability is on the side of this date range. Even if this year doesn't work, chances are the following year, the year after that, are going to be working. So this is how I analyze, and this is how we take a look at securities and their patterns. It really doesn't take that much to look at it like this. However, what you see on the left, the opportunity table, makes it 1,000 times easier. We analyze around 1 trillion data points and come up with a list of the best patterns for every single day, and we rank it by Sharpe ratio, which I'll explain shortly. Now, in this presentation, I also have gold as something that has worked really well last 10 years, but it is not working well this year yet. Let me show you what I mean. I am myself in this GDX. GDX is VanEck Gold Miners ETF. Here's the trend chart for this. GDX. So here it is. I am in GDX, and my position that I went in on the 16th until now is down. It's down 5%. Am I going to stay in it or not? Well, I'm going to analyze and take a look to see if it actually has a chance of going back up based on history. So right now I'm looking at the past 10 years, right here. The most interesting thing to look at is the trend chart, which is right here. Look at what happens after opportunity window. This is the opportunity window right here. The trend chart is still going up. That means the average direction of GDX in the past 10 years following the end here, which is 24th, was still up, and it went up all the way to here. Let me go select it. So I just selected this date range all the way to when it goes all the way to its maximum peak. We see that, don't look at 24, well, 2023 was a loser, but we have a lot more data. We have 17 years. Looking at the last 17 years and looking at MAE, which shows us the maximum adverse, it actually looks like, oh, has a chance of going back. So even if this position is a loser by the 24th, although I'm in option positions, my options are, whenever I go for I just buy call options. Either I do verticals or I just buy naked call options. I do it several months in the future in order to minimize the time value loss. I'm gonna have videos on that in the future. So I'm gonna stay in this position if it's not a winner at the end of this. And the reason for that is because this trend chart shows that after 24th, it's still an up move for most of the historical years. And when I take a look over here, I see that we have a good chance of going back up. I also can click on MFE and actually see what was the extent. Look at this. In 2009, this day trend was a loser, but it first went up 8%. I would have been out with a profit. That would have been a winning year for me. In 2023, it went up 6.24%. I would have been profitable last year. I would have been out for sure. This would have been a winning year for me. What years would I have lost? I would have lost probably here or been close to break even, but that probably would have been lost in 2010. And I could have been break even in 2012 because it went up 3.25% first before dropping. I would have been profitable in all the green ones. And now the question is, what's going to happen in 2024? Only time's going to let us find out. I am staying in this position if it's not a winner by Christmas Eve. So let's go back to the presentation. So what is this Sharpe ratio that I keep talking about? I mean, many people already know what the Sharpe ratio is, but it's a very basic finance term, which is really helpful for ranking our opportunities in TradeWave. So Sharpe ratio tells us how much reward, profit in our case, we're getting compared to the risk we're taking. A higher Sharpe ratio means you're earning more profit for every bit of risk. And it helps you pick trades that give better returns with lower risk when you look at history. So if you look at history and you can find out you had a high Sharpe ratio, which means your returns were pretty consistent year to year, that is a lower risk opportunity. I like this analogy. Actually, ChatGPT came up with this one. It's like lending money to, if you're lending money to a friend and you're charging them, I mean, they're giving you some extra money because you lend them money. So if friend A always pays you back with a little extra, it's safe and steady. You know this friend is okay to lend to because they're going to give you your money back and some. Not a lot, but some. They are low risk. But friend B sometimes pays you a lot, but other time doesn't pay you back at all. This is a risky friend to lend to. It's unpredictable. You have no idea what's going to happen at the end. And this is very similar to Sharpe ratio. Friend A would be a high Sharpe ratio. Friend B would not be. Would be a low Sharpe ratio. So how do we master TradeWave? There are two ways to take a look at it. First, there are two steps to take. Step one, we go to the opportunity table. Let's take a look. We select the market we're interested in, whether it's Forex, US stocks, or some foreign stocks. I usually go to S&P 500 or Wilshire 5000, which is all of the tradable stock in the United States. Let's go to Wilshire. And let's make sure we're today, 19th. So this has been generated by TradeWave by analyzing 1 trillion data points and coming up with this list for every single day of the year. Wilshire 5000's top of the list is RPM International. Look at it. It actually is a down opportunity. It is 47 days, and it's between today, which is December 19th, and February 3rd. So in the last 10 years, if you shorted this, you would have made an average gain of 5.41% on a short opportunity. How much data we have? Ooh, we have more data than I thought. But if you go back to the last 39 years, you see that that wasn't the case all the time. It actually, prior to 2012, it was doing much better than it's been doing the past 10 years. So would I trade this? I usually try not to trade short until the market shows me, S&P 500 shows me it's on a down cycle. It's been on an up cycle so strongly lately for a long time now. And not until I am sure that this has turned to down and somewhat of a bear territory, I don't feel very comfortable with short opportunities. However, even if I would to go on short opportunities, and I suggest the same to you guys, is that short opportunities, it would be better to not risk a lot. Try to control the risk as much as possible. However, TradeWave does a great job at analyzing short opportunities also. Let's look at another opportunity. COO, Cooper Companies. Cooper Companies, it is an average of 9.81% opportunity with a Sharpe ratio of 2.24, and it lasts 78 days. It's a $92 stock. It looks pretty decent, and the opportunity is from today until March 19th. Not a bad one. I also like to click on MFE on all of these and actually see the extent of move. Look at this. Now we can see that this stock actually goes up quite a bit before it closes down. It jumps up and then it eases back down. Look, the lowest it has gone was about 10% in 2021, but then it ended up closing with 2.95% profit. In 2017, it also went up over 10% and then ended up being 7.39%. All the other years was much higher. This is a great opportunity. It is a little bit long, but it's good. I consider this as a decent opportunity. Sharpe ratio is about 1. Usually Sharpe ratio of 1, or actually even I would say 2. On a 10-year opportunity is pretty decent. Now, here's my favorite. Church and Dwight. I use their toothpaste. They are pretty reliable stock. At least this is how TradeWave shows it. See, Church and Dwight right now, it's an 11-day opportunity from December 19th until almost end of the year, 29th of December. It has gone up a tiny bit, not a lot, and 1.67%, but it's been consistent. Let's see What if we look at last 20 years? Look at this. It has done the same exact thing for 20 years. In 2007, it even went up 1.84% and then closed minus 2.58%. I believe this goes to 24 years. Here's a 24-year amazing 96% probability, which actually, if you're targeting, really low percentage, like 1.5%, you would have gone out a winner in 2007 too, 24%. Prior to that, it wasn't. No, it was. It went up 6% before closing minus 2.08. 30. Every single year, it has gone up 4% and then lost. Gone up 6.42% and then lost. Although this percentage is so low, this is very, very reliable. And I'm looking at 30 years. We have 39 years of data. Here are some losing years. These 3 years would not be making money. 86, 87, 88. Right after that, you would be. So we have dropped this by 4 years. So 35. It will be a loser in 92 also, but pretty amazing pattern. This is the type of patterns you find with TradeWave. By just going to opportunity table, taking a look, clicking it, and trying to analyze it. That's all you need. Just target high Sharpe ratios. It's safer, although it's not always necessary for high Sharpe ratio, as long as you click on MFE and see if you can actually target a much higher percentages on even the years that were losers. But these are probability models that you won't find anywhere else. And there's one reason you won't find it anywhere else, because they don't exist. Nobody's gone to this extent. How about other things? We go to Dow 30, JP Morgan. However, the Sharpe ratio is 1.79 based on last 10 years. This is not bad at all for a Dow 30 stock. Pretty decent for 12 days. Today until the end of the year, 30th. Caterpillar, loser in 2020. It was 90% based on last 10 years. United Healthcare. This is a long one, 238 days. However, in 2022, in the middle of COVID, it did lose. Minus 1.68%. This stock is not good at losing. Best way to put it. And so on. NASDAQ. Top on the NASDAQ is AstraZeneca. Loser in 2014. Sharpe ratio is low, 1.51%. It's actually not really low, but it's lower than the other ones. I usually look for Sharpe ratio to be about 1. Although I do look at even slightly below that, as long as the MFE covers the problematic years. Analog devices. Pretty cool one. God, this gives you ideas. I have from one of the users at TradeWave a very cool thing. He said, he's like, I just discovered these stocks. I didn't even know they exist. It's the same for me. I've discovered so many things that I didn't even know I could trade. Here's S&P 500. Cooper Corporation's on the top of the list. And then Church and Dwight. Cooper has a higher average profit than Church and Dwight, although it's only 11 days. It's not bad. Now, what do we do after we find an opportunity? Next thing we want to do is really dive into it, kind of like I just did. But there are other things you can do also. You can check if the recent events have impacted the stock or the market. And for example, United Healthcare just dropped sharply after the news about the CEO being murdered in New York. Although that time of the year, it was typically on a seasonally uptrend. It went up. That was not a good time to be in the stock. Also, you should take a look and see how the security has moved before, during, and after the selected date range. Kind of like we just talked about GDX, how the trend chart shows an up move after the after the date range we just took a look at. That gives you a good idea about if it's a good idea to stay. Is the probability with you for you to stay, to see if the opportunity recovers or not. At least that's how I look at it. And you can use this information to decide when to exit. For example, I'm not exiting GTX. Why? Because we just saw an uptrend on the trend chart after the opportunity window was over. So I'm staying in the GDX, even if it's a loser, after New Year's, Christmas Eve. Also, this is definitely a good idea, especially for more experienced trader, and that's the tip on the bottom. Always combine TradeWave's insight with your research for the most confident trading decisions. There's a hedge fund trader that uses TradeWave, and he says that he filters the opportunities with TradeWave as he's increased his bottom line by not going on opportunities that are on a trend in the wrong direction. So let's look at some of the TradeWave features. There's so many of them. So the first one is, you're taking a look at a huge list right now. I am on S&P 500. We have 261 opportunities. When I go to Wilshire 5000, you have 598 opportunities. And look, the first one is 47 days, second one is 78 days, the fourth one is 137 days. Well, depending on your style of trading, you might not be interested in longs or short. I mean, very long opportunities or very short opportunities. Let's say I want to do trading, and I want my trades to be less than 50 days. I can go here, click on filter, and type 2-50. The list immediately gets filtered by opportunities that are between 2 and 50 days. So you're not going to see anything that the number of days for the opportunity is more than 50. And so on. So what other filters can we do? We can do it by Sharpe ratio. How about if I want Sharpe ratio is always greater than 2? Gives you the list of anything that has 2 or higher Sharpe ratio and nothing else. How about if I want my average profit to be greater than 10? Oh, right, this one does not work, does it? Oh, 10%. No, this one doesn't work. Let's click on average profit here, and we can just, I just sorted it by average profit. Look at it, this top one average profit is 72.66%. Celsius holding. Sharp ratio is low though. Why is Sharp ratio low? Look at this. The returns, although has been quite impressive, are so inconsistent from each other that makes the Sharp ratio low. Why do we drop 2014? 2014 it went up 300%, 500%, and then it was substantially higher than all the other years. Why do we drop this year 2014? We're looking at the last 10 years. We can switch it to last 9 years. Oh, there. Let's switch it last to 9 years. Look at what happened to Sharp ratio. It just went up about 1. So that's a little bit better. So let's take a look at the next thing. By the way, another filtering thing that you can do, let me just show you quickly. If you wanted to if you just care about short, you can go on the filter and type short. These are all the short opportunities in Wilshire. And here it is. The top of the short on the, I just sorted it with Sharp ratio, is 2.29, which we already took a look at. The next one is FIS, National Beverage Corporation. That's short also. So if you decide any time that the broader market has gone into bear market and you don't want to trade long, this is how you look at short patterns. They come right up. And if we go and take a look at the trend chart, see, it shows you it's on a downtrend. We see another downtrend, for example, here. It may not be as good, but we can look. Yep, this is 60% of the year's downtrend between March 7th and March 25th for Barrett Business Services. Another thing that's important to understand in TradeWave and basically the seasonality is the number of years in the pattern. Let's go and look. Right now, let's select S&P 500, and right now we're taking a look at 10-year patterns based on last 10 years. What if we're interested in patterns based on last 20? Click on 20. And we see that Church and Dwight, the first one that came up, and the second one is Republic Services, and you can see 120 days and 252 days. They have been positive 20 out of the last 20 years. I can also click here and go and select, I'm okay with 19 out of 20 years. That's a 95% probability. You get a larger list. Still you get those two on the top, but then Striker. Striker is also there. 19 out of 20 year profitable. It wasn't profitable in 2007. But all the other years it was. And the average gain was 9.31%. I could have changed this to 16 years and took a look at it. It's a 16-year profitable pattern without any missing. Look at the trend chart. It's pretty sharply up during this 60-day pattern. This is a pretty good one. Starting today until February 16. You can go higher. Let's see if we can find 40-year patterns. Usually there aren't any 40 out of 40-year patterns. But I just picked 34. How about 35? Now that when I select this 35 out of 40 means the lowest you can show is 35 out of 40 years. Got to be profitable. So let's click on one of them and see. Here it is, Eaton Corporation. It was profitable 92% of the years over 40 years. Even the year here, 2010, that it lost, it went up 12% already. This is already average gain of 14.9%. You could have been winner there. This would be 95% profitable over 40 years. Only went up 5.86% in 2021 and then dropped to a loss. Here's Chevron. Chevron has a very profitable date range right around here. Average profit of 14% in 180 days. So it's a six month opportunity between today and June 16. It's done quite well. It did not in 2019. It dropped 18%. Other years were modest drops. But for example, here in 2022, 10.55% up. You could have easily been out with a profit or break even also. These 3 years would have been a loser. This year would be a flat up, but not really a loser. So this is well over 90%, although it just shows 88% over a 40-year period we're looking at. So these are the decisions you have to make with TradeWave. What are you comfortable with? None of these things are written in stone, how many years you have to look for these patterns. You can even go and look at 5 years. So how about opportunity based on 5 years? Now you can see these staggeringly high Sharpe ratios, but that's because we're only looking at 5 years. So these are basically just relative Sharpe ratios for the purpose of ranking. People usually look at more than just 5 years, but you can look at 5 years if you wanted to. And you can look at more. We even have some based on 42 out of 50 years. So this is 84% of the years profitable on Disney Corporation based on last 50 years. There's one for Coke. Profitable almost 15% over a 228 days opportunity. So this is how I use these years. By default, it jumps into 10. It seems to be a pretty decent number to take a look at for opportunities, but you can easily just change this to any number you wish. You just have to make the decision of how many year history makes you comfortable in order to find patterns. So I'm going to show you a few other features of TradeWave pretty quickly. So you can create multiple portfolios and put your opportunities because there are just so many date ranges that I care about. Here's I created one for Santa Claus. For example, here's what we were talking about earlier about the Santa Claus date range that TradeWave found. So I put it in here by clicking on plus, and I can recall it by just clicking on that. So he brought back the 96-day opportunity we talked about earlier. So I can add anything into here. Let's just go to my favorite stocks, for example. Oh, here's my favorite stocks are losers. Let's go to, well, sure, CHD. I like, oh, remember we looked at last 24 years. That was 96% of the years was profitable. Actually, probably 100% of the years, if you target the average profit, it would have been profitable in 2007 also. I like this. I want to keep it. I click on plus. It's on my opportunities right there. A cool thing that it does, it not only you just click this to recall it, it also creates this report. I guess it doesn't. No, when it's working, it does. Oh, something's wrong. Well, this is going to work by the time you guys look at this video. I just got to look at talk to the codes. You can also set up a calendar events to remind you of the start date and the end date. You can do it on Google Calendar, and it's just going to remind you when a pattern starts and when it ends. So it's going to help you trade or invest. You can also put a certain number of shares and then track its gain and loss right there. Let me see if I can bring up one of these. Yeah, here's the report that was created. Something went wrong with the other one, but this is the kind of report it creates. These are all custom reports, and they are all static custom reports, so you can literally copy and paste this link to an email or a Facebook post, and whoever comes to it has access to the same exact thing right there. Not only that, whoever you sent this to, they can go and click on load on wave viewer and have it loaded back right on TradeWave. Another thing you can do is select any of these and click on a note and write a note. If you go back, you're going to see that there's a note available. How else can we share with this? Whenever you go to any screen like this, you can click on download right here. It downloads a JPEG. And this is a JPEG you can put in a presentation or in an email and send it to someone. You can also download a CSV. That just gives you all this data as a CSV. And you saw the custom reports. When you add something, when it's working, you can click on a custom report. I think this one worked. And this custom report is shareable by the URL itself. So here's another pretty cool thing here. Let's say I am interested in Microsoft. I am interested in the last 20 years of Microsoft, but I want to know, January is coming up, how does Microsoft perform in January? Just go to the months and quarters and select on January. And you can actually see how has Microsoft performed for the last 20 years if you bought it at the beginning of January and sold it at the end of January. So it shows you the exact performance based on that month. We have 37 years of data for Microsoft. Here it goes. How about February? Ooh, doesn't look good in February from 99 until 2009. And also, 4 years of February is not a good month for Microsoft. You see up here, it turns that square to red. That means TradeWave thinks it's a better short opportunity than a long, because there are more years that it went down instead of up. March. March is a better year, much better than February. And take a look. This turns out green. So it's a long opportunity. It was profitable 62% of the years. You can also do it by quarters. How does Microsoft perform in first quarter? 22 out of 37 years was profitable. Second, third. How about by seasons? Microsoft in spring was 70% of the springs was profitable. 62% of the summers was profitable. 78% of fall was profitable. And only 57% of winters was profitable. You can also look at any, wherever you are, year to date. That's from the first trading day of the year until today. Here's the performance based on all the years you're looking at. And today, till the year's end, not a great one for Microsoft here. It's actually more of a, it's definitely a short opportunity with an average gain of 2%. So Microsoft has been going down 2% from now till end of the year, in average. And then buy and hold. What if you bought it at the beginning of the year until the following January 1st? And then started over? That means you're never out of the market. Here's the year-to-year performance of Microsoft. Very impressive. Only year 2000 had a 62% drop. Year 2008 had a 41% drop, and the rest was not as much. Very impressive stock. And then here is my favorite, which is called reverse date range. But I'm going to show you an example of what reverse date range is. Let's go and take a look at Apple for the last 43 years with buy and hold. Apple is probably one of the most impressive stocks ever. It went public in 1981. If you would have bought it in 1981 when it went public, and you would have held it till now, you would have gained 155,000%. This is in 43 years. Is absolutely impressive. Here's the trend chart based on the last 43 years for Apple. Do you see that it has times that it goes down quite a bit, or here? And one of the most prominent times that Apple goes down is really month of September. Let's take a look at that. I just selected September, and that is from beginning of September to end of September. The square turned red. That means this is a short opportunity. It was a winner as a short 27 out of last 43 years. Apple just does not perform well in Septembers. What if you wanted to know how does Apple perform? If somehow you magically knew to be in Apple only 11 months a year, sell it at the end of August, buy it back at the beginning of October for last 43 years. So if we select September here, and imagine this being in a Roth IRA, so no tax implications. All I have to do is click on reverse date range, and it switches the date range from 1st of October to end of August, completely eliminating September. Look at the cumulative return. It went from 155,000% through 3.69 million%. You could have been killing it. You would have made, I think if you would have invested $3,000 when they went public and kept it till now, you would have made $1 billion by now. Actually does even better. I mean, this is not a realistic exercise unless you have a time machine, but it's pretty impressive how it shows how vulnerable a stock like this can be during a certain time of the year. Look at that. I just adjusted it a little bit. So now the date range we're holding is from October 3rd until September 4th. And cumulative return went to 8 million%. Yeah, it's an optimum time. So this is pretty impressive. More impressive than that is this one, AMD. We have 39 years of AMD, but my God, AMD goes down in the summers. Look at this. Right there. So I just selected the date range for AMD, which the trend chart shows a downtrend like this, which is between May 28th and October 26th. And then I'm going to go and click on reverse date range and look at what happens to cumulative return. It goes up to 13 million%. By holding this stock only 213 days a year. Pretty amazing. Yeah, this is the data you want to memorize in case somebody invents a time machine and go back in time. Or just take TradeWave data with you. All right. I think we're at the end. Just one quick note that I like to show you guys is S&P 500 with 96 years of data. I am going to select indices common, select SPX, select buy and hold, and select 96 years. So we already looked at this in the past, but look at what I can do. I can use presidential election cycle for filtering. If I select presidential election cycle, this is this year. It shows you exactly, you see year to year is 4 year different. This is the performance of S&P 500 buy and hold on every presidential election year since 1928. The last two that it dropped, actually made a video beginning of this year looking at this and predicting that 2024 was going to be bullish, and it went up 23.81%. How about the following year, presidential election +1, which 2025 will be at? It's been pretty reliable up since 1985, but prior to that was quite vulnerable. It lost money quite many of the years. But since 85, it's been pretty good. 2001 dropped 10%. Midterm election years or presidential election +2. That's pretty bad. I would say year 2026 has a highest chance of being a down year. It was a down year in 2022 and 2018 also. And my favorite, presidential election +3 or the year before a presidential election. It is the most bullish year in the presidential election cycle. I actually have a video from 2023 making this prediction, and it was a time that there was a lot of doom and gloom coming out. I didn't believe it myself, but TradeWave was right. It went up 24%. This is it. This is TradeWave, and this is how you can use TradeWave to do not only analysis for the broader markets, but analysis for longer term investments or analysis for short-term trades. See you soon in other videos.